All right, today is Monday, May 18th, and it's probably been about a month since I did my last COVID-19 update. So here we go. So, how has it been treating me so far? Um, Surprisingly well, especially from a financial standpoint. I try to stay home most of the time, but I live in an area where there's a lot of open space around me. So I do get out and take my walks. I do go shopping for my parents roughly once a week. Um, and I try not to go to the grocery store as much as I can, but I go when I need to. So I'm not too terribly concerned about it. I dash in and out, have my mask on, try not to touch anything, all the usual stuff. And so far, knock on wood, it's been pretty good. Um, from a financial standpoint, I am doing surprisingly well given the circumstances. Um, as of the close today on Monday, May 18th, I'm down about 6.5% for the year. Um, that's for the year, not from the high, which, considering all that's going on and all the bad news that you're hearing, um, it's surprisingly, a not bad result, to be completely honest. There are a couple of things I'm reading that is a concern to me. There's a guy that I respect that seems to know what he's talking about that works in the credit market. And he's thinking that there's going to be this credit crunch going forward that hasn't made itself clear yet. And that's going to spur another wave of selling. And we may actually have this double dip recession. And I'm trying to think, what I should do about it. His thinking seems to be that you should take advantage of the highs and, the highs from where we were 2 months ago in March, right? And move into alternative securities like bonds or cash or money market or whatever it is. Wait for the second drop. You may miss out on some short term gains, but once it does drop again because people are panicking, you can get back in relatively cheap. That's the thinking. And then I have a friend that is really smart and I respect, who didn't really comment on that question that I posed, but basically said, to be really secure, you want to have 5 years of living expenses saved up, liquid, ready to go. Uh, and then second, don't be afraid to buy when everybody's panicking. So I think that's sage advice. I don't have a problem with the second point. I never am hesitant to buy in, even when people are thinking the worst. I did that a while ago with the NASDAQ index, and it's worked out fabulously for me so far. Um, as for the first point, I don't have 5 years saved up yet, but I'm working on it. I'll get there. In any case, so what's the situation for me personally? From a financial perspective, I said it was good. And what's the perspective that I'm talking about, just so that I can wrap my head around it, and not panic and overreact and all of that. Um, I kind of looked at my trajectory and where I am today, and then where I need to get to in order to feel secure, and how long that's going to take me in a number of months. So I have a chart that I'm putting up here, and I'm looking at it in front of me. And at first glance, it's pretty complicated. Um, so let me simplify it and kind of tell you the punchline. Um, Basically, from the market closes as of today, and if I keep my strategy, it's basically telling me that about 54 months away from financial independence. Okay, that's 4.5 years. So exactly 4.5 years at 54 months. Um, Basically, what this means is that, assuming a safe rate of withdrawal, I will have enough at that point where my nest egg is going to generate enough income to cover all of my expenses. This is at kind of the base level. Um, I'll be very comfortable, but I won't have a lot of extras for pretty much anything else. But what it does tell me is that if the shit was going to hit the fan, I'm going to be basically okay, staying in the same place, doing pretty much the same thing, and able to cover all my bases and maybe even able to take a trip or two a year, modest trips. But yeah, very, very comfortable. But like I said, not a whole lot of extras for luxury and not a lot of margin for error. So that's what financial independence mean. And 54 months is not a very long time. That's less than car payments for many people these days. Um, it doesn't mean that I'm going to stop working or anything like that at that point, but because there are other considerations. You miss friends. Um, Healthcare is super important. I'm not going to qualify for Medicare until say 65. So whatever happens, I would have to provide uh, to that point anyways. And the less time that I have to do that, the better. But this number really does uh, tell me that I can not worry, basically have that fuck you money, right? That you may have heard about. But yeah, 54 months. That's as of today. Uh, the green line is kind of the best case scenario based on the high at the middle of February, right? So we were really doing gangbuster for a long time in the market. And basically, what this is saying is that uh, when I was looking at my trajectory back in February, it was saying I would hit this number in 42 months, which is 3.5 years. That's crazy. 42 months. It's ridiculous to think about, but that's what it says. Um, and then the last line, this red line, is kind of the worst case scenario. So I'm looking at this chart, and it's basically saying that I would hit my FI number, financial independence number, um, about 73 months from now. 73 months is just over 6 years. It's 6 years and 1 month. And that's the worst case. And you may be thinking, well, where are you getting this worst case? Well, the worst case was right around the middle of March when my portfolio kind of hit the lowest point for the year, right? And this is even taking into account all the stuff that I did before then to try to mitigate that. And I'll go a little bit into it. I don't want to make this video too long, but that's the worst case. So what is this saying to me? This is saying that I'm actually in pretty decent shape, and it's going to allow me to sleep very well at night. It's basically saying that in 4.5 years, I'm going to hit a number that I really don't have to worry for the rest of my life, really. Anything that I do extra above and beyond that just adds to quality of life and margin of safety, right? Um, that makes me feel pretty good. What this is also telling me, just to put things into perspective, is that the absolute worst that could happen, and I think that I've seen, the worst earlier this year, is that okay, I can't do it in 4.5 years, but I can get there in 6 years, which again is not that long and not that bad. And in the best case scenario, it's some 42, 41 months from now. And I'm tracking this on a monthly basis, and I'm going to continue to, just because I think it helps me. I'm a data freak and like to look at it. So yeah, it's pretty good. So you may be looking at this and saying, okay, how'd you figure this out? Well, the yellow line is pretty simple. The phi number, that's basically just at the base level, 25%, 25 times what my annual cost and expenses to maintain this lifestyle. And that works out to be a 4% withdrawal rate. Some people call that a safe withdrawal rate of 4% from my nest egg. I think that's the maximum you can go and still feel reasonably safe that you can make it in the long term. Taking less out of your nest egg is better, of course. This is what I was talking about with working longer, building up that cushion, not only for extra luxury, but that margin of safety as well. So the assumption here is getting to 25 times my annual expense as the nest egg. The other assumption that's a big assumption in here is that the average annual return that I would see for the next 4 to 6 years or longer is an 8% annual return rate on average. Does this mean that in any given year I can't have a negative or down year? No, not at all. It just means that over an extended period of time, I should be averaging 8%. That does include reinvesting dividends. So I think that 8% is a fair rate. Some would argue that given our current environment of depressed returns, that's a little high. I actually think that it's fair because historically we've seen much higher returns, especially when you count dividends. So I think that 8% is not bad. It's fair, and I'm comfortable with that. So those are the big assumptions going into the model. So that's why you see the lines are roughly on the same slope, going up. It's just one's either closer to the present in terms of months or further away. That's all it means. So overall, I think I'm doing pretty good. So back to what I did to try to mitigate, all of this stuff that we're seeing now. Earlier in the year, I was talking to some friends, and I was saying that, I think it's time to take some profit. And this was back in mid-February, late February, and I actually went ahead and did it. I sold 30% of my portfolio mid to end of February, and was patting myself on the back. And in hindsight, that was a really good move. I couldn't do everything. Part of it is that where I work, I need to get clearance for trade, and this was just selling ETFs and mutual funds to get to that 30%. Otherwise, I probably would have pulled the trigger on up to half, right? So that was on the balance of good things I did. Bad things. Where do I start? Out of that 30% that I raised by taking my profits at the high of the market, I went ahead and put about 10 to 12%, so a third of that chunk, into the energy stock. And in hindsight, if I had waited, I would have done much better. This is before oil hit negative dollars per barrel and all that jazz, because COVID-19, everybody's staying home, no one's driving, people aren't shopping. So, even the shipping industry, the travel industry, the demand on oil is just ridiculously low. It's taken such a bad beating that, in hindsight, should have waited. My thinking was that energy was, especially oil, was getting such a bad rap and just getting the shit beat out of them that it just didn't make sense. Everybody thinks electric cars are coming, and yes, they are, but it's just going to take a long time for us to get to a place where oil is not the main source of energy, right? That was kind of the thinking. And it was also a dividend play because it was paying like 6.5–7% dividend on costs. If it continues to pay that, I'm really not worried that my oil stocks have gone down some 35–40%, right? Because I'm still getting a really great dividend that I'm reinvesting in at low levels. But that's one of the things that hurt me even after my brilliant move of cashing out. The next thing I did that in hindsight, hindsight's always 20/20, is that I took another 10% of my portfolio from the cash that I generated and bought real estate REITs. And the thinking there was that, one, I wanted to diversify my holdings, and I don't have any kind of REITs or real estate at all. And I was thinking about being buying an investor rental place and just being a landlord, right? But didn't want to deal with the hassle and all of that. So I figure, REIT is perfect. They generate a lot of income. They don't make land anymore. You've heard that saying as well. Well, with COVID-19, all of that has gone to hell as well. So I lost about half of that holding. And then the last third of the 30% that I liquidated, I reinvested at the very low. I think I paid $169 a share for QQQ, the NASDAQ ETF. and have done fabulously well. So the net effect of all of that is probably neutral, right? I made a great move selling at the high. I bought two investments, 2/3 of that cash that didn't do so great. I'm still holding on. I'm not panicking and selling out of them, but it just didn't do too great. And then the third that did do great is just making up for the other 2/3 that's kind of doing crappy. But overall, taking everything into account and looking at my phi number and how long it's going to take me to get there from here, it still doesn't look that bad. So that's the perspective that I'm talking about, so that I'm not panicking and worrying about what's going to happen and all this other crap. In any case, it's a long update. I hope you found some use out of it. And I always tell people that I talk to that ask me about this stuff just to take a step back, take a breather, and not lose the long-term perspective. Anyways, I hope you find it useful, and I'm signing off. I will come back with another update at some point here, hopefully more often, but I'm not a YouTuber. I just put stuff out basically when I feel like it. So thanks for the patience, and see you guys later.